Hello everyone, in this video I am going to teach you Unit 2 of Banking Awareness, that is RBI, its act, its regulatory framework, monetary policy. All of this we will going to study in this video. Without any delay, let's start the video. Let's come to the topic history and establishment of RBI. RBI is established in the year 1935. Before 1935, the Empirical Bank of India was quasi-central body of India. At that time, the central bank work is done by Imperial Bank of India up to the year 1921. Imperial Bank of India is currently known as SBI, which is nationalized in the year 1955. Okay, nationalized in the year 1935. Before nationalization, RBI was set up. Understand? Okay. RBI set up in 1935, which is before independence. So, at that time, all the decisions were taken by Britishers. Okay. So, after the Imperial Bank, which is created by merging Bank of Bengal, Bank of Bombay or Bank of Madras. Those are the presidency bank. Presidency banks are merged and create a new bank, Imperial Bank of India, in the year 1921, which is nationalized in the year 1955 and create a new bank, SBI. Okay. But in RBI was established in the year 1935. The Act was RBI Act 1934. This bank is established on the recommendation of Royal Commissioner Hilton Young Commission. Before, the headquarter of RBI was Kolkata, but after it was shifted to Mumbai, Maharashtra in the year 1937. Then later on, RBI was nationalized in the year 1 January 1949 after independence. Okay. Now the question is, how many members are there in RBI? There are total 21 members in RBI. One governor, four deputy governor, governor and deputy governor tenure is for 5 years. Then two government officials nominated by Ministry of Finance, 10 directors nominated by Government of India, then 4 regional directors from the region Delhi, Mumbai, Kolkata or Chennai. Now the question is, what are the functions of RBI? There are so many types of function, but the main functions are monetary function, non-monetary function, supervisory function, regulatory function or prohibitory function. Monetary function means RBI controls the money supply in the economy, maintain price stability, regulate all the commercial banks. These are the monetary functions of RBI. Also manage the FDI, FPI. All these are coming under monetary function. Then the next one is non-monetary function. Non-monetary function means promotional function. Means RBI promoting loans to the agriculture sector, promote loan in housing sector, real estate business, promote housing loan through National Housing Bank, or promote industrial setup, entrepreneur. All these are coming under non-monetary function or promotional function. Then supervisory function. RBI supervise all the activities of the banks like commercial bank, cooperative bank, special finance bank, and also provide license according to the bank's capital or asset to formulate a new bank, okay, or formulate a new private bank. Then the regulatory function. Obviously, regulatory function means RBI regulate the commercial banks, money market, NBFCs, All these are coming under regulatory function. Then prohibitory function. RBI cannot provide any direct financial assistance to any industry or trade. It cannot purchase or sell any commercial or industrial share undertakings. It cannot buy its own or other banking company's share. It cannot purchase any immovable property. It cannot give loans to the security of shares and property. It cannot participate in business or trade. All these are prohibitory function of RBI. Now the question is, what is the objectives of RBI? The objective of RBI is, first, it is the currency issuer or the regulator of issue of banknotes, then maintain foreign reserves, then operate the credit and currency system of the country, then stability, maintains price stability. Now the question is monetary policy. What is monetary policy? Monetary policy is formulated by Monetary Policy Committee, where the authorities are takes decision on control of supply of money, control on supply of money and maintain price stability, and the which tools are used, known as monetary policy tools. Okay, and the tools are, there are two types of tools: quantitative tools or qualitative tools. Quantitative tools means which is measured in numbers, or qualitative tools means which are measured in quality or the performance. What are the objectives of monetary policy? Maintain price stability, control flow of credit, promote export, promote economic growth, stability for national currency. Okay. Now the question is, what are the qualitative techniques of monetary policy? First, open market operation, where RBI sell and purchase the government securities in open market, that is known as open market operation. Then bank rate. Bank rate means where RBI lends money to commercial bank for the long term purpose without any collateral, that is bank rate. Then repo rate. Repo rate means RBI lends money to commercial bank with collateral for a short term period, and that collateral is government securities. Okay. Now the next one is reverse repo rate. Reverse repo rate means when commercial bank lends money to RBI at which rate, that is known as reverse repo rate. Then CRR. CRR means cash reserve ratio, which means the commercial banks should maintain a percentage or a proportion with RBI called as CRR, means commercial bank maintain a rate with RBI in the form of cash, that is called as cash reserve ratio. Then SLR. SLR means statutory liquidity ratio, the statutory position or the statutory portion maintained by commercial banks within itself, and it is known as SLR. These are the quantitative characteristics of monetary policy. Now let's talk about qualitative characteristics of monetary policy. Qualitative techniques means this method is used to control inflationary pressure in the country. So the first one is rationing of credit, means limiting the credit through variable portfolio ceiling or variable capital asset ratio. Variable portfolio ceiling means limit the loan amount. Then variable capital asset ratio means bank asset is to capital asset ratio. Bank asset is to bank capital ratio, that is known as variable capital asset ratio. Then the second one is customer credit regulation. RBI makes guidelines to banks in respect of credit regulation. Make a limit. Understand? Then fixing of margin requirement. RBI fixes the margin of to which purchaser of securities may borrow against securities. For more percentage down payment for a non-essential loan installment. Understand? Then control through directives. Guidelines issue to commercial bank for controlling by the RBI. Then moral persuasion. It takes the form of written letters and holding discussion between the RBI and banks about trends in economy in general and in money, credit and finance in particular, and about the measure which is ought to be taken from time to time in light of nation objective. Then publicity. Publicity means the rules regulation must be published known by the commercial banks should be